Hey, what's going on, guys? This is Sam Kwok here, one of the Kwok Brothers, and boy, do I have a video and a story to tell you guys today. Now, Redfin just reported that we're at all-time high when it comes to home median prices all across the country, but economists are starting to think that we're gonna see cool down in prices next year. The Federal Reserve is hinting at increasing interest rates, and we're looking at 68% increase in foreclosures in quarter 3 of 2021 when compared to quarter 3 of 2020. But equally, there are forces at play here that could increase the home prices next year, such as the federal government making changes to Fannie Mae and Freddie Mac, increasing the loan limit of $1 million, and we're looking at the $1 trillion infrastructure bill that just got passed, and Biden's $15,000 tax credit for a first-time home buyer is still at play.
No and then!
And then?
No and then!
And then?
No and then!
So it really seems like the housing market is giving us mixed signals. It's giving us cold shoulders, and sometimes it gives us kisses and loves. So what is going on? Are we going to see home prices actually cool down, or are we going to continue seeing home prices go up? Now, what isn't a mixed signal is our sponsor, Truebill. Truebill is an all-in-one finance management app that I personally use to help me lower my bills, track my subscription, also track my budget as well. The app allows me to connect my bank account and credit cards automatically so that it can pull all the transactions and budget them accordingly. My favorite part, honestly, is that it helped me lower my internet bill by $20 every single month. And then I contacted Truebill through the app, and they helped me lower that $70 internet bill back to $50 for the next 12 months. Even better is that Truebill lets me know when it detects an out-of-the-ordinary transactions so that I can take a look at it to see if it's a fraud or if it's something that I overspent in certain categories. So guys, I personally use Truebill to do so much more, so go download your app today by going to Truebill.com/Kwok Brothers, and that's again Truebill.com/Kwok Brothers. So start using Truebill like me to track your expenses, lower your unwanted bills, and monitor your credit score on your app. Now guys, I've done hours of research figuring out which forces are at play here that can completely change and shift the momentum of the housing market. I totally get it. Real estate is completely local, and depending on where you are, you may experience different degrees of how this can change your market. So we're gonna talk about some of the major changes that are gonna happen across the country that can have a shift in your local real estate market as well. And we'll do a separate official 2022 housing market predictions pretty soon here, so definitely stay tuned and subscribe to our channel for that video. Now, this is probably the first thing that everyone has in their mind right now, and that is the foreclosure wave. Now, Realty Tracker is reporting that there's a 68% increase in new foreclosure starts, and over 350,000 homeowners have exited the forbearance program in the past 3 weeks. And just by hearing those numbers, it sounds like the tide is turning for a tsunami. But the truth is that in the last 2 years during the pandemic, we pretty much had no foreclosures being done on federally backed mortgage programs, which means that any adjustments or any increase could look like a large increase when compared to last year. And of course, the CFPB, Consumer Financial Protection Bureau, has anticipated a potential for a foreclosure wave, and they made it a rule pretty much no mortgage companies and banks can start the foreclosure until January of 2022. And what's interesting is that big platforms like Motley Fool is predicting a climb of foreclosures in 2022 using the same data that we got from Realty Track. And because in the last 2 years, banks and mortgage companies weren't able to foreclose on anybody, one can argue that we might be looking at a large foreclosure bubble that could pop and burst in 2022. So will we see a large foreclosure wave hit the market on January 1st, 2022 right off the bat? I don't know. I don't see it. And I've been saying this over and over again in our channel. I really believe that it's not gonna be a giant foreclosure wave, but it's gonna be a slow trickle and tranches of waves coming in throughout the next 5 years. Now, look at the data with me here, and of course, all of our research and links are down below in the description so you guys can do your own research. But Realty Track reports that it can take up to 2,070 days to complete a foreclosure process, and this specific number is from Hawaii. Now, the fastest state for a foreclosure to complete is Montana. So as far as how fast a foreclosure can happen and hit the market at the same time varies depending on state, depending if your state is a judicial state or a non-judicial state. And since it could take 2,070 days for a foreclosure to be complete, if you're in Hawaii that is, that means that we may not see the effects of foreclosures happen even for another 3 to 6 years in certain states. But here's another thing to consider, and that is if an individual is in a pre-foreclosure process, they could in theory sell the home before the foreclosure process can complete, which means that they can walk away without a foreclosure, although their credit might be shot due to late payments, but that could potentially add inventory back into the market without necessarily having to go through the foreclosure process. And honestly, this is gonna be really hard to predict because we can't really tell whether the mass will choose to do that or they will go through the foreclosure process. And if someone claims that they can predict the market and how it's gonna turn out based on the data that I shared, I don't know, they could either be a fortune teller or a 14-year-old crypto expert.
Shiba Inu token is really going to the moon.
Now, the other forces at play here is Federal Reserve. Now, the Federal Reserve already came out saying that they're going to stop buying mortgage-backed securities. They're going to start tapering it, which does have impact on the lending market as well. Now, this could be important because as Federal Reserve stops buying mortgage-backed securities, it could lead to lenders and mortgage companies to put their guards up and do less of lending, because what the banks and mortgage companies hope to do is they take the loan that they just lend and sell it to Fannie Mae, and then Fannie Mae packages it into a mortgage-backed securities and sells it to other investors, which in this case, Federal Reserve is one of the buyers. But if the end user, which in this case could be a Federal Reserve, stops buying mortgage-backed securities, it could potentially lead to banks and mortgage companies slowing down on new originations and new mortgages. And slightly related to that is the Wall Street Journal just reported that Federal Reserve with tapering could also increase interest rates sometime next year. And one of the main drivers for this is that Federal Reserve is now realizing that inflation may not be transitory. And frankly, I was wrong about this as well. I mean, I'd be more than happy to admit that I was wrong.
I was wrong.
And so ultimately, the Federal Reserve is kind of retreating back its statement as far as inflation being transitory. And one of the tools that they're now considering is increasing interest rates. Now, inflation just dumped a whole lot of money into the economy. And what increasing interest rates will do is pull back some of the money supply back into the Federal Reserve, which could potentially slow down inflation. Now, of course, the byproduct of that is mortgage rates will go up as soon as the Federal Reserve increases the rates. And when mortgage rates go up, buyers who thought, hey, this is a really cheap money, now may have second thoughts about buying and may wait or just choose not to buy at all. So ultimately, less buyers, meaning that there's less demand, and that could lead to prices of homes cooling down in 2022 if the interest rates do go up. And of course, if this is combat inflation, and let's say inflation does come down, what we're all hoping for is raw materials and labor costs will go down, which will help and motivate developers to build new homes. Which then further solves the issues of the housing crisis right now, because right now the underlying problem is that we're missing 5 to 7 million housing units, and we need more homes. We simply need more homes. That's the number one solution that we need right now to combat the housing crisis challenges, especially multifamily homes in urban areas. California, I'm talking about you.
I knew it.
Now, so far we've been talking about the downward pressure as far as what could potentially cool down the home prices. But of course, there are also upward pressures that could potentially change the momentum of the housing market once again, and we'll see an increase of prices. So here they are. Now, one of the new forces at play here just got mentioned yesterday, and that is that the Fannie Mae and Freddie Mac will increase the loan limits to $1 million in expensive neighborhoods in California, New York, and New Jersey. And currently, Fannie Mae and Freddie Mac has a limit of $820,000 in terms of the loan size that they're willing to back. But just recently, inspired and influenced by the federal government, Fannie Mae and Freddie Mac is looking to increase that limit to $1 million. What this ultimately could translate into is that now individuals looking to qualify for $1 million home can be qualified with the guidelines that Fannie Mae and Freddie Mac creates. And that could potentially bolster up the demand and more buyers entering the market in these already expensive neighborhoods in places like San Francisco, LA, New York City. Although some may argue that this could solve the housing crisis, I honestly think that this is going to completely do the opposite.
I'm in danger.
And further destroy housing affordability, mainly because what you're doing is you're artificially driving up prices because now there's more artificial demand due to the fact that more people can qualify for higher limit loans. Now, I've said this before time and time again, that the real solution to places like California and New York is to allow builders and developers to build more homes without the red tape. Cut down the permit process, cut down the amount of regulations that involve in just building a stinking multifamily. So instead of working against the people that want to provide more housing in your area, why not work with them and allow them to build more homes in your local government? And only then can we cool down and stabilize the prices in these expensive neighborhoods. Now, the second forces at play here is something that we mentioned already last week, and that is the $1 trillion infrastructure plan. Now, this just got signed. All three government bodies signed it and it becomes law, and the government is now going to spend $1 trillion in improving, repairing, and building infrastructure for the country. Now, I said this in my last video, but I do see the potential where this bill can increase the value of some of your neighborhoods as well as land in your metropolitan area. As we build and repair bridges, roads, highways, ramps, well, we're gonna see neighborhoods around those areas improve and increase in value over time. But the other school of thought is that a lot of you guys have mentioned that this could potentially increase the property taxes in those same areas, which also has a downward pressure on the home prices. Take, for example, in 2017, when Tax Cuts and Jobs Act was passed, pretty much any property taxes over $10,000 could not have been written off in personal taxes, which meant that a lot of individuals who were paying more than $10,000 in property taxes were choosing to sell their homes to move into a smaller home, or at least homes that weren't paying over $10,000 in property taxes. That quickly made it all these top tier price homes go down or at least stay in the market for a very long time until it was discounted and ready for the next buyer. So overall with the infrastructure bill, I do see key areas and neighborhoods increasing in value, home prices will go up, and these areas, even with foreclosures and interest rates going up, may continue to see increase in home prices and value of land. And one of the last forces at play here that's major is what I think a lot of people have forgotten and aren't talking about, and that is the $15,000 first-time home credit buyer that Biden has promised during his presidential campaign. I mean, this was literally on his website during his presidential campaign where he promised $15,000 to all individuals that are buying their home as a first-time buyer. If this were to get introduced in 2022 and some by miracle it gets passed, yes, it could definitely increase home values all across the country, as all of a sudden we're gonna see first-time home buyers thinking, okay, well, you know, Biden's gonna give me $15,000, therefore I'm just gonna go buy a home, get an FHA loan or one of these first-time home buyer programs, and now all of a sudden we just introduced massive demand to the market. And I think even if the interest rates do go up by 0.25% or even 0.5%, we're gonna see enough motivation because of that $15,000 number, we're gonna see a lot of people flood in to buy homes as a first timer. But of course, with the basic supply and demand play here, as we see more demand and more buyers, that'll only increase the prices, which kind of negates the whole $15,000 credit part in the first place. In other words, because there are more demands and more buyers, let's say a $100,000 home yesterday is now $115,000 simply by the nature of demand. And even with the Biden's $15,000 credit, you're basically back to where you started at $100,000 home price. I mean, let's say for example, there's a house worth $100,000 and Biden's $15,000 tax credit gets passed tomorrow. Well, wouldn't you think because of the demand, we're gonna see that home price go up to $115,000 or $120,000 just by the virtue of demand, which basically means that $15,000 credit doesn't really mean anything because that $100,000 home is now $115,000. And not to mention there's gonna be a bidding war that could potentially increase the price even more to let's say $130,000 or $140,000. And of course, this is just my opinion, but is the $15,000 first-time homebuyer credit actually helping? So guys, all in all, the housing market is so strange. I mean, Daniel already talked about how 2021 was a weird and interesting year for the finances. I mean, what do you guys think? Are we gonna see home prices continue to go up or at least stay warm? Or are we gonna see a massive cool down on home prices? And I think at this point, a housing market crash is out of the table. I don't think we're gonna see that anytime soon, unless, you know, of course, North Korea attacks us or China invades Taiwan or something weird happens. So I don't know if I missed anything, guys. Go and mention it down below in the comment section. Did I miss anything? Am I not seeing anything? Or do you disagree with me or agree with me? Share it with your comments down below. And of course, as always, if you leave your comments down below within an hour of publishing this video, I'll definitely comment and join on the conversation. Go and leave your comments down below. And of course, we'll have an official 2022 housing market prediction video coming for you guys pretty soon. So definitely subscribe, smash the like button if you thought that this video was insightful and valuable to you in any way. So that being said, guys, love you all, appreciate you. I'll see you guys in the next video.